Okay, gang, if you've heard enough people tell you that you should really be using a high-yield savings account, here's what that means and what you need to know. First, a savings account is kind of what it sounds like. It's an account that allows you to save money by parking it there, and it also allows your money to grow each month based on a set interest rate. The bank or institution holding your money gives you that interest in exchange for being allowed to hold your cash. And if you're wondering, well, wait, why would a bank want to pay me to do that? It's because they benefit from having you as a customer. More specifically, they benefit from having your money on their balance sheet because it gives them more cash to work with and to lend out. Our money helps them make money, so it's only fair they give us some of it back. Now, going back to the point of today's video, the traditional savings account that I've just described typically pays out that interest at an incredibly low rate. As of this video, the national average interest rate for a traditional savings account is only 0.41%, which is actually on the high side, gang. Meaning if you manage to put $100 into that savings account, you'd earn a whopping 41 cents at the end of 1 year. That's not even going to get you 15 minutes at a parking meter these days. What if you could save your money and get paid at a much higher interest rate? That's what a high-yield savings account offers. It's a place to park your money, but to get paid at a much higher rate. As of this video, the typical APY for a high-yield savings account was 4%. Now, keep in mind, rates are higher than they've been in the past because of everything going on with the federal government's interest rate hikes. But even if high-yield savings accounts only offered a rate of 2% right now, that is still far better than the 0.41% we just talked about. Okay, now you're probably thinking, what's the catch here? Is the structure of a high-yield savings account somehow riskier than a traditional savings account? And the answer is generally no. As of this video, both types are typically insured by the FDIC up to $250,000 per depositor. Of course, though, that depends on your financial institution. And like a traditional savings account, high-yield savings accounts aren't dependent on stock market conditions in the way traditional investing would be. That's why you'll find many finance experts and content creators touting the pros of getting your money into one of these accounts. Oh, and as of this video, gang, you don't need to have a certain credit score to open a high-yield savings account. So it really can be a great starting point for anyone, regardless of your credit history. Now, that said, there are things you do want to be aware of before you make that decision and before you decide how much money to park into those high-yield savings accounts. For starters, you want to make sure you're giving your money to a bank or institution that can be trusted. At minimum, they should carry that FDIC insurance guarantee because that will protect your money in the event the bank fails, because banks have failed, gang. And of course, this also assumes that the government really comes through in the event that happens. But FDIC insurance, super important. You also want to make sure there are clear ways to contact your institution for support in the event you have issues accessing your funds or otherwise using their platform. Things happen. You also want to be mindful of that institution's rules when it comes to minimum balances, transfers, and withdrawals. Some high-yield savings accounts will require that you maintain a minimum balance in order to keep your account open, to earn the advertised interest rate, or to avoid fees. They may also limit the number of times you can withdraw money in a given period and charge fees for certain types of transactions. Or they may have limitations in how easily you can transfer money in and out of your accounts. All of this translates to less flexibility than the traditional savings account you might have with your primary bank. That doesn't have to be a bad thing, but something to keep in mind if you plan to dip into your savings account pretty often. Now, another thing, if it's important to be able to access your high-yield saving account money via an ATM machine, that's something you'll need to dig for, being that it's a rarer perk. And finally, as with any financial account you ever open in your life, be super mindful about fees, gang. We talked about transaction fees and minimum balance fees already, but make sure you're aware of any other universe of fees your bank or institution may charge, especially maintenance fees. Now, for what it's worth, there are plenty of reputable high-yield savings account options that don't charge any maintenance fees. So as a general rule, you'll probably want to go for those. Okay, so now that you know the perks and caveats to using a high-yield savings account, how do you decide which one, or which ones, because you can always open more than one, to go with. Well, in addition to the things we've already discussed, like FDIC insurance, ease of access, and fees, the other big thing you'll want to focus on when making your decision is around the interest. How much money do you stand to gain from this account? Now, some institutions will have slightly varying interest rates or APYs. Generally, you want the higher rate, but of course, that's only assuming that the rest of the package you're being offered is actually fit for purpose. For example, a high-yield savings account that offers a high introductory rate may seem great. But if that rate lowers significantly after only a few months, it may not be the best option on the table. And in that same vein, gang, make sure you understand something called compounding frequency. Now, let's talk about compound interest for a second, because compound interest is a when we're talking about credit card debt or personal loans. But it's a godsend when we're talking about earning money in investments and savings. Basically, it's the idea that the bank pays you interest not only on whatever amount you put into your account, but on whatever additional interest they put in too. So the compounding frequency refers to how often interest gets added to your account balance. And obviously, the more frequently that happens, go for daily or monthly over yearly, for example, the more money you stand to gain. And that's all we have for high-yield savings accounts, gang. I hope this video was helpful in breaking down how they work and how you should consider them in your savings strategy. Comment if there's anything you would add or if you have any questions. If this video was helpful, please do give it a thumbs up because it lets me know to make more things like this. And for more tips, be sure to subscribe.